Good evening, everyone. Welcome to our webinar. My topic tonight is which SGX-listed stocks or ETF will benefit from the China reopening theme. My name is James, market strategist at uSMART Securities. And we are partnering with SGX for this Singapore Trading Festival, and hence we are conducting this webinar tonight. We have another one to talk about Safe Haven Singapore stocks this Saturday at 10 a.m. So if you are interested in our next topic, building a resilient investment portfolio with Safe Haven Singapore stocks, please tune in this Saturday. And we are also giving out $15 cash voucher as well for this event. If you are assisting uSMART customer, we would like to reward you with $15 cash voucher. All you need to do is provide us your uSMART ID at the end of the webinar in the Q&A box. And we will then issue you the $15 cash vouchers to your uSMART account within 5 working days. And upon receiving the cash voucher in your account, you can redeem the cash voucher by executing one trade on Singapore Stock Exchange, be it buy or to sell. If you cannot remember your uSMART ID, it's okay. You can also provide me your email or your handphone number in the Q&A box in the Zoom webinar. And what you type in the Zoom Q&A box will not be shown to others, so do not need to worry about that. If you do not have an uSMART account with us yet, you can still provide me your name or your email, but please open the account in 1 week time and then email us on this email address here, support@usmart.sg. We will then issue you the cash voucher. Okay, so let me begin with disclaimer first. This presentation is for education and sharing purpose only and does not constitute to any form of advice. Past performance is not indicative of the future performance. Today, I will talk briefly about China market outlook, and then you can also see that the main theme for China this year is reopening, and hence a lot of investors are excited about this reopening play. But I also believe all of us have heard enough China reopening news for the past 3 months, so I hope I can share with you something new in this webinar. And I also want to share with you that what stocks or ETF can benefit from the China reopening and that are trading on Singapore Stock Exchange that you can invest using Sing dollars to trade or to invest easily. Let me go through some of the macro economy before I talk about individual stocks or ETF. The major theme for China this year is China reopening. Basically, China reopening could mean earlier economic recovery. While a lot of countries here, the economy are slipping into recessions or already in the recession zone, China seems to be the one or the first one coming out of the recession and should be entering the early recovery phase soon. This is why if you talk to any analyst in the beginning of the year, all analysts will basically tell you that China will outperform US this year. And it almost sound like an easy trade for every investor. So when I met up with my friend from an asset management firm to talk about China in January, and at that point of time, he was also so bullish as well. Everything about China is just sounded so rosy with the reopening play, loosening China regulations, and Hang Seng Index at the point of time probably was already up by 10% when I met up with him. So he was asking what my opinion is about China. I say to him that China should be 10 to 30% allocation in your portfolio, but not to overexpose yourself. And I think this could be a repeat of 2022. So in 2022, everyone was so optimistic about China in the beginning of the year, but then it crashed and only recover most of the lost ground in the final quarter of 2022. So I say to him that I don't think investors should be thinking about adding more if they already have enough exposure in China in a pure stock portfolio. Maybe 30% is the maximum holding you should have. And eventually, Hang Seng jump up by another 4% to 14% before come crashing down. So why China stocks, China stock market crash? Firstly, I believe that investors are overly optimistic on the economic data due to reopening, but economy does not shoot out immediately after reopening. It always takes time to reopen and takes a while to show you good economic number. Secondly, the most important reason is China investors tend to overprice in the future. If you have been through the phases of One Belt One Road, Hong Kong Stock Connect, you will know that they tend to pump up the stocks when they first see the news headline, and then they will subsequently dump it. For example, if the realization of the news itself can bring the stocks prices up by 20% in 3 years' time, they will just pump the stock price up by 20% in 3 days' time or in 3 weeks' time, and then just dump it because they don't want to wait for 3 years. So probably the China reopening news could ultimately bring the Shanghai index up by 10% in 2023, or the Hang Seng index up by 14% at the end of the year. But investors just decided to pump out the stock prices to the year-end target in 1 month time. So this is why you can see that the excitement was the peak near the end of January itself, and then just call it a day. Because the economy again takes time to reopening. So investors are just impatient to wait for that. Having said that, I would say that my year-end target for China indices are 10 to 15% upside to last year closing price. And now since the stock markets has corrected, it's one of the better timing to accumulate. So let's take a closer look at some of the economic data. If we were to look at PMI number, both manufacturing PMI and service PMI are above 50, as we can see over here, which are in expansion phase at the moment. But some people may argue that the manufacturing PMI number represented in the white line over here actually swing in between expansion and contraction a few times in the past 1 or 2 years' time. So they may say, how could I be sure that this time that the PMI number can maintain above 50? My argument is it was swinging above and below 50 due to COVID measure, due to lockdown measure. And now with the China reopening, that should not be any lockdown anymore. So I see the PMI number staying above 50, be it for manufacturing or service, that they will stay in the expansion mode for the rest of the year. Another indicator to see if China is in expansionary is by looking at the import and export growth. The latest February data show us that China import year-on-year growth was 4.2% in February, and the China import was doing 4.2% growth in February, and the China export was doing negative 1.3% growth in February itself. And I like to see the import growth is larger than export growth, because it's telling me that China economy is coming out of a contraction and moving into expansion itself. And for the most part of 2022, the PBOC has not substantially expanded his balance sheet. But things started to look differently near the end of 2022, that we can see that there is a huge uptick over here, meaning to say China is expanding its balance sheets, that there will be more liquidity available to the capital market. And other than that, China also cuts a reserve requirement ratio RRR for all the banks 2 weeks ago. All this measure indicated that China is trying to boost its economy. And next, I also want to paint you a bigger picture here. Basically, if you are looking for growth, you cannot avoid China. According to World Bank report, during the 2013 to 2021 period, China's contribution to global economic growth averaged 38.6%, higher than all the G7 countries combined. So it tells you that you simply cannot ignore China. Why this is important? Because when you invest in a company, you want to find one with good earnings, because over time, the stock price tends to follow the earnings growth. And if you are investing in a country, you want to choose the one with a strong GDP growth rate, as this will likely translate into growth for various sectors, earnings for companies, and ultimately a higher price in the country index over time as well. And lastly, I want to show you the GDP per capita. The graph on your left is GDP per capita in 2021. So what is GDP per capita? It basically tells you that how much each citizen of a country contributes to the country economy in monetary terms. It is basically determined by dividing the country GDP number by its population, and it serves as a measure of the country overall productivity. So as we can see over here is that US is 5.6 times greater than China in terms of the GDP per capita. But if you were to look at the population number, China is 4 times larger than US itself. So if we were to do a little math here, 5.6 times 4 equals 22. So what I'm trying to say here is, if China is able to grow its GDP per capita to the same size as US, it means China GDP growth is going to be exponential at the end of the day. So how can China do that? China can basically boost the internal demand. Household consumption accounts for less than 40% of China's GDP, whereas in US, the consumption accounts for 70% of GDP. So this is why you have been hearing a lot of people saying that for the internal demand in China, there is still a large room to grow. So all in all, there is massive growth opportunity in China in terms of consumption, investment. And if you believe that China will continue to be the economic powerhouse, I think investors should include China as part of their long-term investment portfolio itself. And I think that if you want to benefit in China reopening, the most direct way is to invest in China companies. However, there are not a lot of China companies listed on SGX. So I would say that the best way to gain exposure to China is investing in a China ETF. And I also want to change your mindset as well. If you want to invest in China, you should probably focus on growth stocks rather than the value stocks itself. As a Singapore investor, it's likely that you have already owned a lot of value stocks listed in Singapore. Additionally, there are a lot of good value stocks in Singapore that you probably are more familiar with. Therefore, I don't believe there is a significant need to invest in Chinese value stocks like the China bank stocks when DBS, OCBC, and UOB are better banking stocks relative to China bank stocks itself. This is why the China ETFs I want to introduce to you are mostly growth ETF. So let's talk about the Hang Seng Tech ETF first. Lion-OCBC Securities Hang Seng Tech ETF is designed to track the 30 largest technology companies listed on Hong Kong Stock Exchange. So they are basically involved in cloud computing, digital, e-commerce, fintech, internet, and autonomous. And it is the most popular China ETF listed on SGX. Traded currency is in Sing dollar and US dollars, meaning to say you can buy the Sing dollar share class or the US dollar share class, but probably you would like to look at the Sing dollar share class because the liquidity is better. And overall, this ETF, Hang Seng Tech ETF, is also liquid as well. The AUM is standing at 330 million. 90-day average aggregate volume is 8.9 million shares, meaning to say every day the transacted share volume is about 8.9 million. The bid-ask spread is 0.002. And if you were to look at the list of the technology stocks here, I believe you are familiar with most of them. Tencent, 美团, Xiaomi, Alibaba, 快手, Jingdong, Li Auto, Baidu, SMIC, JD Health as well, just to name a few. I think most investors probably assume that the regulation shake-up is over and the effect of common prosperity is also not felt anymore. So this ETF has revived a lot of interest this year. But to me, I would say that because of common prosperity, I will always apply a China discount to the technology stocks here. It means that I don't believe that these technology stocks will be able to reach the high valuations they had before, like in 2020, anytime soon. And there is always overhanging policy risks that are going to bite them in the future. So I think going forward, state-owned enterprises will outperform these private companies. In Chinese, we call it 国进民退. I see that China state-owned companies also have more buying interest this year as they are also cheaper in terms of valuations. And I think that SOE could outperform these private enterprises, these technology stocks itself. But I also see that this year you could be seeing lower interest rate, lower discount rates are conducive for these technology stocks. So I reckon towards the end of the year, there could be some technology companies rally in US and then causes the Hong Kong technology stocks to rally as well. So I basically think that this year, Hang Seng Tech ETF is okay. Having said that, I think this is still a trading market for Hang Seng Tech ETF. You can be patient to time your entry. There is no rush to go in itself. If you are thinking about investing for long term, I would say that probably you should invest less than 5% of your portfolio. I do see that US-China technology war will make a comeback, and I believe that the total addressable market for some of these companies are quite limited to China as well. So that's why this ETF is suitable for traders for short-term trading. If you want to hold it for long-term, again, less than 5% of your portfolio. And next, let's talk about Nikko AM straight tradings, MSCI China Electric Vehicles and Future Mobility ETF. Quite a mouthful itself. In short, China EV ETF by Nikko AM. So good things about this ETF is that they do not only look at car maker, they also look at companies which produce the hardware and component. They look at software companies, they look at infrastructure companies like energy storage companies itself. The ETF benchmark against the MSCI China All Shares IMI Future Mobility Top 50 Index. And unlike Hang Seng Tech ETF that have a lot technology giants that will sometimes face the regulation tightening going forward as well, this EV industry is one of the top priority for China. And the country is committed to providing significant support to the EV sector. To put it simply, China does not want to miss out on the economic opportunities that the EVs will bring, especially since China has missed out on the era of the internal combustion engines itself. So having said that, EV industry will have all the support from government. It's good to have, it's good for long-term investment, provided that you are able to withstand the volatility of this EV industry. And I think that this year will be a good year to enter, as I see there will be more corrections in the industry since Tesla is lowering the selling price, that it could make some of the EV maker go bankrupt in China. On a side note, one thing I like about this ETF is the top holdings is CATL. So CATL is Ning时代. It is the largest battery maker in the world, is the battery provider for Tesla, with about 10% weight in this ETF. It also has other EV maker like NIO, BYD, Geely, Li Auto as well. The liquidity is quite decent at about 163,000 shares transacted per day. AUM is 33 million itself. And let's talk about UOBAM Ping An ChiNext ETF. And I believe that a lot of the investors here may not be familiar with this ETF, as the benchmark index is ChiNext itself, which is composed of 100 largest and the most liquid A-share listed and traded on the ChiNext market of the Shenzhen Stock Exchange. To put it simply for you, you can think of it as China's version of Nasdaq, that the ChiNext market aims to provide investor access to the new and the fastest growing Chinese technology companies. Unfortunately, I think that Singaporeans may not know most of the companies on ChiNext. Like the company I think most people are familiar with are probably CATL, Ning时代, and East Money, Dongfang Caifu, and probably what else here? Yeah, and probably If Energy. But other than that, they could sound a bit foreign to you. So I think this is probably the reason why the liquidity is a bit disappointing at about 29,000 shares on the 90 days aggregate average volume itself. The bid-ask spread is about 0.005. AUM is 13 million. I hope that the liquidity could be better in the future. Nevertheless, it's a good ETF if you want to partake in Chinese technology companies to enjoy some of the exciting performance that the index bring itself. This is the UOBAM Ping An ChiNext ETF benchmark performance that it show you that in the past it could swing quite widely. For example, in 2015 it returned 84%, but the next year it went down by 27%. And you could see that some years it could easily go return 80-something percent, 40-something percent, 60-something percent. 2022 it returned negative 29%. This year, year to date, is about 1% upside. And one important characteristic about this ETF is its low correlation with other global indices itself. And this is one of the things that I like about this ETF. It's good in the way that whatever crisis is happening in US or across the globe, it does not really concern ChiNext. For instance, the correlation that you can see with MSCI Asia, SGPAN, STI, S&P 500 are quite low itself. The correlation between S&P 500 and ChiNext is 0.012, while the correlation with the STI index is 0.156, and with the MSCI All Country World Index is 0.128. And I think that is probably due to foreign retail investor cannot buy stock listed on certain stock exchange. So even I tell you that CATL is one of the best company in the world, you are not able to buy that because you are not professional investor. But if you declare that you are probably a professional investor or institutional investor, then you are able to buy. Otherwise, right, ChiNext is mostly open for local investor to invest itself. And just to quickly talk about the China stocks that is listed on SGX, NIO. NIO is currently listed in US, Hong Kong, and Singapore. It is a pure EV company and is the only EV company with the battery swapping system itself, which means when your EV runs out of battery, you can just bring the car to the battery swapping station by NIO, and it will help you swap the battery into another fully charged battery in 3 minutes time. All you need to pay is a monthly subscription fee for the battery swapping service. It is targeting the premium customer, evident by the high selling price in China. The share price once went up 1,100% in 2020, about 3 years ago. And it was lauded as China Tesla at that point of time. But after 2020, the share price keeps coming down. In 2021, it returned negative 35%. 2022, it provided a negative return of 69%. Year-to-date return is negative 5% itself. So why the share price of NIO keeps coming down? Firstly, the revenue growth is below expectations. Previously, we can see that in 2020, the revenue growth for second, third, and fourth quarter are above 100%. In 2021, it was 480% revenue growth itself. But it was quite disappointing for 2022. It's only double-digit revenue growth year on year. But the revenue growth rate was 62% in the fourth quarter last year. It was probably due to NIO lowering their profit margin to push for more car sales in China itself. So the profit margin was once quite good at around 20% in 2021, but to push through more sales, it has been dropping its profit margin that you can see in the latest quarter, it was only 3.9%, which is similar to a traditional car maker itself. And recently, with Tesla cutting the selling price in China, NIO also cut prices in China as well, further hurting the profit margin. So I guess the worst probably is not over yet for NIO. I would prefer to see the profit margin bottoming out before calling a bottom for NIO. So I think that if you are looking for an EV maker, NIO is still a good EV maker that I like. You may prefer BYD, but it is not listed on Singapore Stock Exchange. All in all, it is still a trading market for NIO now, probably not a good time for long-term investing, but I still think it's worthwhile looking out for this company. Just look out for a better entry price to see whether the profit margin rebounded itself or not. Another company that would probably benefit from the China reopening is the Singapore Airlines. The investment thesis here is, since China reopened, you should see more international visitor arrival in Singapore. And it was doing about 1 million international visitor arrival in February itself. And it was 1.5 million on average in the year of 2019. So it is still some good upside potential that China tourists should continue to push this number up. And even without the China reopening, I would say that Singapore Airlines, SIA, is doing fine lately as well. So in the latest quarterly financial report ending December 2022, it can be observed that the net profit that show over here for the first 9 months of financial year 2023, which is standing at 1.9 billion itself, right, is already higher than the entire year of 2019 net profit. And why, you may ask? The main reason would be operating leverage. Operating leverage is just how much of each incremental dollar of revenue that a company can turn into profit. So during the COVID-19 pandemic, some companies are able to cut the costs like overhead, headcounts, and post-COVID, they still keep the cost cuts when the economy recover. So this is why they are able to generate more profit. So SIA previously cut a lot of labor. SIA does not really need to fully recover the revenue level from 13 billion back to 16 billion in 2019 itself, because of operating leverage. You already cut your costs substantially, and this is why you are able to be more profitable. That's all I want to present today. Before I move into Q&A sessions, I would like to ask you to leave your uSMART ID or your email address or your handphone number in the Q&A box in the webinar itself. We would like to reward you with $15 cash voucher. It will be issued to your uSMART account within 5 working days. And upon receiving this cash voucher in your account, you can redeem it by executing one SGX buy or sell order. Again, if you do not have an account with us yet, please still provide us your name or email in the Q&A box, and please open the account in 1 week time and email us to inform us as well so that we can keep track and issue you the cash voucher. Okay, and now we move on to Q&A session. Okay, it's a good question here. Is there any China-related Singapore S-REITs that you recommend? So I take that as you are asking, is there any REITs that listed in Singapore that is China related? Okay, thank you for the questions. I would say that there are a couple of them. The first one would be Easy World REITs. It is a China e-commerce REITs, but I think you can forget about it now because it's having some going concern. And there is another one called Daxing Retail Trust. But the last I checked, I think they are being issued a letter of demand as it failed to make the interest payment. So I think you can also forget about Daxing for now. There are BHG Retail Mall and the Outlet Mall Salsa REITs that are probably doing okay. But BHG and Salsa REITs, I would say that I have not studied enough to say that they are good for long-term investment, but I would say that they are worth studying. And lastly, the one that I'm more familiar with is the CLCT. CLCT is Capital Land China Trust, which I always think that is the best choice here if you are looking for China retail mall REITs. Previously, I spent some time to study about it. I would say that the retail mall are mainly in the city area. And last year, some people don't quite like it because the dividend payout dropped by 14%. But this is because they actually gave out about 1 month rental relief to the tenants at the retail malls there. But again, there should not be any lockdown in China this year. So this is why the dividend payout should recover. You should see an upgrade in the dividend payout itself, the DPU. I think after all, is the sponsor is Capital Land. So the brand name speaks for itself. So Capital Land China Trust, I think, is a good one. The gearing ratio, I think, is a bit high at near to 40%. So the max that you can go is 50%, but 40% for them, to me, is a bit high. I would say that I'm a bit unsure about the tenant mix because last I checked, I think about 32% are in the essential sector like food and beverage. So the tenant mix is unlike Singapore. Singapore is probably close to 50% in the essential sector, but it could be a norm in China retail mall. All in all, I think this is the best choice, but I would say that I would prefer to study more into the properties itself. And I also want to see good recovery in the shopper traffic and the tenant sales before saying that this is one of the conviction buy. Yeah, I hope I answered that. Okay, so what do you think about Genting Singapore as the China reopening play? So, okay, if I'm not mistaken, lately Genting Singapore has gone up a lot. I did not follow the news itself, but I think it probably can be contributed by a good earnings number. I think regardless of the China reopening, when we look at Genting, is a casino stock. And I would say that China tourists, like probably they come here, a businessman or family, they bring their family here and then they probably will go and gamble in the casino itself. And this is why when you look at the revenue breakdown, you could see that 75% of the revenue come from the gaming revenue for Genting Singapore. I think you should ask yourself whether you like the casino stock itself, because to me, I don't quite think that it is a good business model, because for a successful casino business model, to me, I would look at those Las Vegas casino business model that have a lot more non-gaming revenue. And if you want to do pure casino, right, it need the support of the local patrons. and should not heavily relying on the foreign visitors. Having said that, I don't like Genting Singapore because it's always lack of the local patrons. For example, Singaporean or Singapore PR being charged a 100 or 150 entry levy to patronize at the Genting Singapore casino itself. But one thing I like about Singapore, one thing I like about Genting Singapore is the Resort World expansion plan. I believe the news actually say that they are spending about 400 million on the expansion plan on the Resort World Sentosa and call it RWS 2.0. So I guess Genting Singapore also wants to have more non-gaming revenue. So as an investor yourself, you should ask, do you want to give them time to transform themselves? Bear in mind that the Las Vegas revenues, right, 60% of them come from non-gaming, whereas Genting non-gaming revenue is only about 20-something percent, 25%. So if non-gaming revenue can contribute more to the total revenue, definitely would be a good thing to me, because I see that improving non-gaming revenue would be a good long-term catalyst to the share price itself. But I would say that at this moment, I remain neutral on Genting Singapore as I fail to like the business model itself. Okay, can buy Singapore bank stocks now. Okay, so probably I would spend a little bit more time to talk about Singapore banking stocks in my Saturday seminar. I would say that you probably like to tune in for that, but in short, I like Singapore banking stocks. I think that if the global banking crisis continue, local bank stocks get hit, or there would be a global recessions, then local bank stocks will get hit as well. For example, if US go into recession, it will also hit the local banking stocks because local banking stock is cyclical stocks. But I think whoever are buying local banking stocks now are probably betting that the banking crisis will be over soon. Or if there is a recession, it's going to be mild or a soft landing. And I agree with them. I agree that the banking crisis now, as I see it, is not as serious as the Lehman Brothers crisis, and US will probably just suffer a mild recession. So now, again, it's good for long-term investment for local banking stocks, but just to play it safe, you should consider splitting your buying into 2 or 3 tranches, or just use the dollar cost averaging. But I would say that local banking stock is one of the best sector that you can see in Singapore. Okay, what is the difference between KWEB and Hang Seng Tech ETF? Okay, so I think among all the like the technology ETF, right? Like the China one, people are more familiar with KWEB and Hang Seng Tech ETF. KWEB is the China Internet ETF that invests in China technology stocks that are listed in Hong Kong or US itself. The Hang Seng Tech ETF, on the other hand, only buy into stocks listed in Hong Kong. So KWEB ETF listed in US, but you can find the Hang Seng Tech ETF listed on the Singapore Stock Exchange, trading in Sing dollar. And in terms of performance, if I remember correctly, I think Hang Seng Tech ETF outperformed KWEB in probably 1 year, 3 year, 5 year, time frame itself. So this is off the top of my head what I can think what are the differences. Okay, is there a replay for this webinar? I missed the first 10 minutes. Okay, we will post the replay of this the replay itself on our YouTube channel in the next few days. So you can look out for that, or you can just go to YouTube and search our channel. The channel name is Talk Stocks with James. On a side note, again, if you like the content, please also subscribe to the channel as well. Okay. Okay, can you comment on Alibaba? I actually talked about Alibaba in my last seminar, if I'm not mistaken. I think that among all the e-commerce companies like Meituan, JD.com, Pinduoduo, and Alibaba, I only like Meituan at this moment because the Meituan growth still looks sustainable. The growth rate is still quite strong. I am neutral on Alibaba. I think the growth is not so good in a lot of aspects. If you were to look at the cloud computing or you look at the domestic e-commerce growth, it is not exciting anymore. I am interested to conduct a webinar on Alibaba in the future. So probably you can look out for that as well. But I would say that if you are asking what should you do about it at the current junction, at the current price, I don't think letting go at this price is wise. It has dropped a lot for the past few years. So I think it's still a waiting game. It's quite fairly valued now. And also given recently they decided that they might split their units into 6 units. So they also create a lot of good growth story itself. But ultimately, will they spin or not? I really do not know. So this is why if you were to just go back to the basics, look at the revenue growth itself, right? I fail to like the business growth at the moment, or I would say that I fail to like the business model at the moment. Okay, there are a lot more. Okay, this is an interesting question. If I miss the IPO of UOBAM Ping An ChiNext ETF, does it mean that I'm buying the ETF at a higher price now? Not necessary. For all the ETF, right, even you miss the IPO price, the current price at the moment could be higher or lower, depending on the performance of the underlying asset itself. But in this case, if I remember correctly, the IPO price for UOBAM ChiNext ETF was $1, Seng dollar. And now I think it's trading slightly below $1. I did not check the price for today, but I think that it's slightly below $1 at maybe 0.9 something. I think if you are asking, I think you are asking because normally when stock, like a company go IPO, right, they will normally shoot up in the prices on the IPO day itself. I think the main reason for that is before IPO, the stocks are mainly owned by institutional investor, cornerstone investor, and because it's not listed yet, there is not much price discovery to be done. So the price discovery process is not that efficient. But once it's got to the IPO, once it's trading in the secondary market, no longer in the primary market, the price discovery can become very efficient and available to many more investors like the retail investor like you and me to invest. So the stocks normally will shoot out in prices on the IPO day, but it does not apply to ETF. So ETF, like the ChiNext ETF, is just buying into 100 stocks that are already listed in the exchange itself. And the ChiNext ETF itself, right, is just a reflection of the value of these 100 underlying stocks. So if the value of the stocks of the ETF goes up, the price of the ETF will also likely go up as well. So to put it simply, if you miss the IPO date of the ETF, is okay, because the underlying asset does not necessarily go up on the IPO day, as well as the ETF price does not necessarily go up on the IPO day itself. So I hope that I made it clear to you. Okay, so probably let me take one last question. Okay, because we have run out of time. Yeah, so the question here is, which China ETF is best to invest now? Okay, I think it's very much depend on the preference. So all the ETF that I just mentioned, I think they are quite good. For me, if I would talk about a long-term investment, probably I would prefer the Nikko AM China EV ETF or the UOBAM ChiNext ETF itself. So the reason I like the China EV ETF, electric vehicles ETF, is you can only find a pure China EV ETF listed in the Asian stock exchanges, but not in the US stock exchange. So US has their own EV ETF, like the US EV ETF that mainly buy into US stocks, or the global EV ETF listed in US with limited exposure to China. But the China EV ETF is a thematic ETF here that you can have a higher concentration on the China itself. Yeah. And I would say that I'm also familiar with the names inside the China EV ETF, so this is what I'm confident to say that it's also good for long-term investment itself. But again, like I also say to you, some of the EV makers may go default this year itself. Even those are not included in the ETF, but some of the smaller ones, if they go bankrupt, it will definitely impact some of the share prices of the EV in the ETF itself. So again, I would say that something to be cautious here. But again, I would say that because it's supported by China government, the EV industry, so I would say that long-term investment is still quite good. The next one would be UOBAM ChiNext ETF. It's also a good choice. So even though it's technically a China Nasdaq ETF, it's also diversified into many sectors itself. But and they are also mainly smaller growth name and tech name relative to ATMSJ. If you look at it that way, it's small to mid cap companies. Not a lot of them are large cap. So I think it's also quite volatile as well. But it's also depending on how much you like about China and how much you know about China's. Okay, so again, thank you for that. I would say that there are still a lot more questions. I will try to answer those questions in the comment section once I post the video on YouTube. So look out for that. And again, thank you everyone for coming. I hope you have a great night. Happy investment, happy tradings, and I will see you soon.